Hello everyone, my name is Alex Wynn, and today I will be presenting my investment analysis on Carnival Corporation, the world's largest cruise operator. Carnival operates a portfolio of cruise brands including Carnival Cruise Line, Princess Cruises, Holland America, and Costa, serving millions of passengers annually across global destinations. Following the pandemic, the cruise industry experienced one of the most severe disruptions in the travel sector. Carnival, in particular, saw revenues collapse and took on significant debt to survive. However, in recent years, the company has staged a strong operational recovery. Today, I will walk through three key areas: recent financial performance from Carnival's Q4 earnings calls, my operating model assumptions for the company going forward, and the intrinsic valuation and whether Carnival is an attractive investment or not. Starting with the key takeaways from Q4 2025. Carnival delivered record financial performance in 2025, signaling the cruise industry recovery is largely complete. In the fourth quarter, Carnival reported record revenues of $6.33 billion, up near $400 million year over year. Full year revenue reached $26.6 billion, the highest in the company's history, and the fourth time management exceeded its own guidance during 2025. And breaking down the revenue, passenger ticket revenue was $4.05 billion in Q4 and $17.4 billion for the full year, and onboard and other revenues were $2.2 billion in Q4 and $9.2 billion full year. Both segments reached record highs, reflecting strong pricing power and increasing onboard spending by passengers. Operating performance also improved significantly. Q4 operating income was $735 million, and it was up 31% year over year. And for the full year, operating income was $4.5 billion, up 25% from 2024. Management attributed this to strong demand, pricing improvements, and disciplined cost control. Moving on to net income and EPS, profitability improved dramatically as well. Q4 adjusted net income was $454 million. Adjusted EPS was 0.34. This beat September guidance by over $150 million and increased more than 140% year over year. For the full year, net income was $2.76 billion and adjusted net income was $3.1 billion. This represents a 60% increase versus 2024 and more than 30% above management's initial guidance. Adjusted EBITDA, Carnival also delivered strong cash flow growth. Q4 adjusted EBITDA was $1.5 billion, which was a record, and EBITDA margins expanded nearly 300 basis points year over year. For the full year, adjusted EBITDA was $7.2 billion. This is over $1 billion higher than 2024, demonstrating the company's improved operating leverage as cruise demand continues to recover. Moving on to net yields, which measure pricing and onboard spending per passenger, increased significantly. Q4 net yields was up 5.4% year over year. This exceeds guidance by over 110 basis points, driven by strong close-in demand and accelerating onboard spending. Full year net yields increased more than 5.5% over already record 2024 levels. Moving on to costs, Carnival also demonstrated strong cost control. Q4 adjusted cruise costs, excluding fuel, was only up 0.5%. This was 270 basis points better than guidance, reflecting operational efficiency and careful expense management. And moving on to return on investment capital, capital efficiency improved. Carnival reported adjusted ROIC exceeding 13%, and management expects this to rise above 13.5% in 2026, approaching a 20-year high. So now moving on to model, we should look at the historical first to understand Carnival's valuation today. Between 2019 and 2021, Carnival experienced one of the most severe downturns in the travel industry. During the pandemic, revenues collapsed, ships were idled, fixed costs remained extremely high, and as a result, operating margins declined drastically, going down all the way to negative 372%. To survive, Carnival raised substantial debt. Although the company has recovered to $26 billion in annual revenue, the balance sheet still carries large debt load that investors continue to monitor. Right here, the debt's right there. So in my operating model, I assume I assume moderate but sustainable growth for Carnival going forward. I forecast a 5 to 7% annual revenue growth over the next several years. This reflects continued cruise demand recovery, strong pricing power, and increased onboard spending, but however, a slightly reduced growth assumptions from the year compared to recent trends due to several macro risks like the rising oil prices, geopolitical tensions impacting travel routes, and potential economic slowdown. These factors could impact cruise demand or increasing operating costs. Now, moving into operating margins, I project gradual improvement from 15 to 18% over time. This assumption reflects strong pricing power highlighted in the earnings call, continued cost discipline, and operating leverage as capacity increases. So now on to the intrinsic model. To estimate Carnival's intrinsic model, I applied a forward earnings multiple approach benchmarking against industry peers. Carnival has a 2.67 Carnival has a beta of 2.67, reflecting its historically high cyclicity. This means the stock tends to move more significantly than the broader market due to its sensitivity to economic cycles, consumer discretionary spending, fuel prices, and geopolitical disruptions. The higher risk profile justifies a valuation discount relative to peers. I applied a 15x forward earnings multiple. For context, Royal Caribbean, the industry leader in profitability, currently trades around 18 to 20x forward earnings. However, I apply a discount for a lot of reasons. Higher leverage. Carnival still carries significantly more debt than Royal Caribbean. Brand diversification risk. Carnival operates multiple brands across different market segments, creating complexity and potential operation inefficiencies and geopolitical exposure. Carnival's global footprint exposes it to more geopolitical risk compared to peers. Because of these factors, 15x forward earnings represents a conservative but defensible multiple. So now to my investment recommendation. Based on my model, Carnival represents a moderately attractive but higher risk investment opportunity. The company has clearly demonstrated strong demand recovery, improved profitability, disciplined cost management, and record financial performance. However, investors must also consider the company's elevated debt levels, the cyclical nature of cruise demand, and macroeconomic risks such as fuel prices and geopolitical instability. Overall, I view Carnival as a recovery and operating leverage story where continued margin expansion and deleveraging could drive upside. Therefore, my recommendation would be a cautious buy for investors willing to accept higher volatility as the company continues to rebuild its balance sheet and close the profitability gap with competitors like Royal Caribbean.